Index funds have trillions of dollars invested in them around the world, but in our opinion, they are still underrated. In this episode, we're going to explain how the simplest way to invest is still the most powerful. Welcome to Get Started Investing, a podcast where we help you make the most of your money. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are the Index Boys.
Yes,
As the Island Boys fade into pop cultural irrelevance, the Index Boys becomes less and less
known. The reference is lost.
But anyway, the Island Boys, they were a real 2021. They had a moment there.
If our producer can flash up a photo of the Island Boys on the edit for this, that would be great.
Anyway, we're here to talk about index funds because we are the Index Boys. We love them, but we think they're underrated, and we think after this episode, you will love them too. And this episode was inspired not only by our love of indexes, but also by this question from Emily.
Hi, love the show. I'm a beginner investor with a very small investing budget, $25 a week. For the past couple of years, I have used Raise and let it run in the background. But now I want to get more of an understanding of the markets, and I've switched to Sharesies, where I can have a bit more control of where my money is going. I originally split my money between 4 ETFs, tracking the indexes of Australia, USA, Europe, and Asia. Now I'm wondering if I would have been better off just putting what I have into a single all-world index. Would love to hear your opinions on those different options.
Love that question, Emily. If you have a question, head to equitymates.com/contact and ask it there. We would love it if you recorded it as a voice note. We love hearing your voice. We get sick of hearing Bryce read the questions out. But let's cover it. Let's answer Emily's question, but talk about indexes more generally. So we're going to talk about what is an index fund, how they work, their historical performance, what index funds offer, what they don't offer, and the Aussie options that you can invest in.
So much to cover. Let's get stuck in. Before we do though, there's some key points that we're going to be reiterating throughout today's episode. And that is that just because something is simple, it doesn't mean that it will underperform. And just because something is complex, it doesn't mean that it will outperform.
Yeah, investors love chasing complexity.
Yeah.
They love adding risk for no reward.
Absolutely.
But I think the history of the stock market tells us that index investing is both the easiest, but also the smartest way to invest. And that's what we're going to unpack today.
So Warren Buffett is one of the most famous investors and arguably the most successful investor of our time. And he loves index funds, so much so that he has instructed his estate when he dies to put 90% of his wealth into an index fund. And we will unpack a little bit about that towards the end of this episode. But just keep that in mind. One of the most successful investors of our time who has spent his life picking stocks has said he wants 90% of his billions of dollars to go into an index fund.
Oh, I mean, just to double down on that, Benjamin Graham, who was Warren Buffett's mentor, he's known as the father of value investing. He's written some of the most popular investing books, still read today, Security Analysis and The Intelligent Investor. This guy made a fortune picking individual stocks, just right up there in the pantheon of investors. By the end of his life, he was interviewed by the Financial Analyst Journal, and he even said, in light of the enormous amount of research now being carried on, I doubt whether in most cases such extensive efforts around picking individual stocks will generate sufficiently superior selections. The father of modern investing was even questioning stock picking by the end of his life.
There you go.
Everyone, all roads lead back to the index.
All roads lead back to the index, boys. All right, well, let's get into it. What is an index fund? Let's start with the textbook definition. An index fund is a basket of shares that tracks a market index, like the ASX 200.
It's never a good definition when you use the word you're defining in the definition. So let's break that down. A market index takes every stock, every company listed on a market, or sometimes just the largest portion of stocks listed on a stock market, and then tracks them. Regardless of how well they're doing, regardless of how poorly they're doing, regardless if it's a company they like or don't like, no one's making any decision about don't include this, include more of that. It's just we're going to rank them biggest to smallest, and we're going to hold them in that ranking order, and we're going to track them over time and see how they move as a big group.
And so then an index fund is the way in which you invest in that index.
Yes.
So rather than picking stocks through that index fund, you are just buying a bit of all of the companies within that index.
And the history of index funds really goes back to the 1970s. Vanguard is a company that a lot of people who are familiar with investing will know. It's now one of the biggest financial firms in the world. But their start by John Bogle, the guy who started Vanguard, was simply this question. What if rather than putting all this effort into picking stocks, we just bought a bit of everything? We bought the index.
The needle in the haystack, wasn't it? Buy the haystack.
Don't search for the needle in the haystack, just buy the haystack.
Yeah.
And that was his simple premise in the 1970s. And 50 years later, that simple idea has revolutionized the whole financial industry. Now, as you said in your intro, now there's trillions of dollars that are invested in this way. Because the fact of the matter is John Bogle was right.
He was, yeah. Well, let's put some numbers to that, Ren, because as you said, turns out buying a bit of everything has been an awesome strategy. So let's look here in Australia at the All Ordinaries Index. Another common index is the ASX 200, which is what a lot of you would be investing in. But the All Ordinaries Index tracks the top 500 companies here in Australia.
Whereas the ASX 200 tracks the top 200 companies.
Yeah.
So they move very similarly.
Very, very close. So over the last 124 years of the Australian share market, or the All Ordinaries, if you include dividends reinvested, the All Ordinaries has returned 13% per year for the last 124 years.
And
that is a phenomenal return.
And let's just put some numbers to that. Let's say you're investing $50 a week for 35 years, the length of a working life at 13%, you have $1.8 million.
Investing so easy. Investing so easy. Let's take it over to the US though. The S&P 500 index, which is the largest 500 companies in the US.
For an example, and this is an example that we included in our second book, Don't Stress, Just Invest, which was just an ode to the index funds. So if you want more on index funds, pick up that book wherever good books are sold. But using the S&P 500, if you had invested $100 each month from 1976 to 2022 in the S&P 500, so 46-year time horizon, the length of a realistic career, just $100 a month, $25 a week, and you'd reinvested all dividends, you'd have $1.5 million.
Jeez, so good.
So I think that the point that we're trying to make is John Bogle was right.
Yeah.
You don't need to spend all your time picking individual stocks to build meaningful wealth.
Yeah.
That index investing is enough. Now we're going to get into the nitty gritty and explain why that is the case, how index funds have grown so much. And I think to start, we need to just explain the mechanisms of index funds, what's actually happening under the surface when you buy an index ETF.
Well, it's a beautiful mechanism. It's hands off. We don't have to do anything. That's the beauty of these things. So let's take the ASX 200 as the example. That is the top 200 companies in the ASX. You've got your banks in there, you've got your miners, you've got some of the tech companies. Indexes are market cap weighted. So what it means is the order of the companies in the index is based on the size or the value of the company. So you'll have the most valuable company as the number one and the 200th most valuable company as number 200.
I think to really strip it back, you take the 200 companies and what their market value is, and you add it all up together. And so let's say all of the 200 companies in Australia together are worth, for ease of maths, $1 trillion. And then you say, okay, Commonwealth Bank is the biggest company and it's worth 300 billion. So it's 30% of that 1 trillion total. So it gets 30% of the index. And then next is BHP and it's 200 billion. That's 20% of $1 trillion. So it gets 20% of the index. Now those numbers aren't right. They're just to illustrate the point is that's how you market cap weight it. Then all the way down, you get to the 200th company that's still big, but not nearly as big. It might be worth $1 billion. So it's 1,000th of the index. So it's 0.1% of the index.
Yeah. And so, of course, over time, every day, the value of each of those companies moves around. And so what these indexes do most often is every quarter, or at a consistent interval, they will rebalance. So they ensure that they then rejig the index to make sure all the companies are back in the right order with the right percentage amount. So you might find some companies fall out of the index and new companies come in as values change. But the key point here is all of that happens without us having to make a single investment decision on those companies.
Yeah. So the question then becomes, why do index funds work? Why have they performed so well over the past, few decades since John Bogle launched them? And why are we confident they will continue to work? So I think the starting point for me here is some research from Kiplinger, which found that just 2.4% of listed companies are responsible for the majority of all wealth creation. They created $76 trillion of wealth over the past 30 years. So what you can conclude from that is the name of the game is to own those 2.4% of amazing companies. And you can just think about the companies that have generated all that wealth.
Big tech.
Well, yeah, in our lifetimes, it's been Apple and Nvidia and Google and Meta and Microsoft. But in the generations before, it was, Walmart and Boeing. And, in Australia, it's been companies like BHP and Commonwealth Bank. It's like CSL, like these massive companies that have generated so much wealth. The name of the game is to own them and own them early and own them as they grow. And so one way to do it is to scour the market and make investment decisions and pick individual stocks and hope you're right. But remember, it's 2% of the companies.
Yeah.
So you've got to be really good to be picking the right ones. 98% of the companies are duds.
Yeah.
Is basically what this research says. Or just kind of meander along.
Yes. Yeah.
So one way is to do that work and find those 1 in 50 companies that are going to be big wealth generators. The other way is to just own everything, confident in the knowledge that those wealth generators are in everything.
Yeah. And the beauty of the way these index products work is because they are constantly rebalancing and giving you the top 200, you're always going to be owning the biggest companies. Even as companies change over decade and decade and decade, you'll have the best companies as they rise up, and as those that have been at the top fall out, you'll continue to own that top the top echelon.
So let's get practical to sort of illustrate this, because we know that this concept can get a bit confusing. And so let's use the S&P 500, America's index of its top 500 companies, as an example. So as new companies emerge, new technologies emerge, new ways of doing business emerge, different companies are growing and others are shrinking. And we can see the emergence of these new incredible companies by when they get added to the S&P 500. So when they have grown enough to be in the top 500 companies listed in America. So Apple was added to the S&P 500 in 1982. Microsoft was added in 1994. Amazon was added in 2005. Netflix was added in 2010. Tesla was added in 2020. So that's at the point where they were big enough and they ticked all the boxes to make it into the S&P 500. And since being added to that index, they have been the drivers that have pushed the index higher, that have made money for investors. So since 1982, when Apple was added, it's up 105,000%. Microsoft, since being added in 1994, is up 8,500%. Amazon since 2005 is up 4,000%. Netflix since 2010 is up 4,000% as well. And Tesla since 2020 is up 300%. These companies are growing incredibly, and they're the ones that are pushing the index higher. And here's the thing that makes us confident that the index will continue to grow in the future. It's that if these companies stop growing or start shrinking, and there will be other companies that will keep coming through, new ways of doing business, new technologies, new entrepreneurs, whatever it is, that will keep driving the index higher.
Espresso mates. So we continue to build the case of why index funds are awesome, but let's just go through some of the most common reasons why we love index funds. Firstly, common principle of good quality or good investing is diversification.
Yes. And
diversification is made easy through index investing. One purchase, access to hundreds of companies, that's all you need to do. Well diversified. Secondly, they are known for low fees. We hate fees here at Equity Mates, one of our 3 pillars. And ETFs or index funds are incredibly low cost.
To To put some numbers to it, like 20 years ago, the traditional managed fund was a 2 and 20 fund. That were like a hedge. They would charge you 2% of your assets each year in a management fee, and then 20% of any outperformance. Over time, that's come way down. Now, an active manager might be charging around 1%.
Yes.
But then if you look at index ETFs, like let's look at the lowest cost one in Australia for the ASX 200 at the moment is A200, 0.04%.
Crazy.
Yeah. So a fraction of what active managers charge.
Basically free.
I mean, yeah.
Yes. Yeah. It's so low cost. Third reason, which we've illustrated above, is that they have proven long-term performance. We said that over the last 124 years, the All Ordinaries has delivered 13% a year, but you also need to consider it against your alternatives.
Yes.
And your alternatives are active managers, those who are trying to pick stocks themselves and create a portfolio. And when the numbers are not good when you compare them to active managers.
Yeah, S&P Global is a giant finance company, keeps the SPIVA scorecard where they compare active managers and they ask how many active managers in any country beat their benchmark, which is an index fund. So in Australia, let's start there, over the past 15 years, compared to the ASX 200 index, 15% of active managers consistently beat the index.
Not a lot.
15%.
Not a lot.
Nuts.
No.
Let's go to the US, largest financial market in the world. Over the past 15 years, just 10.5% of active managers are beating the S&P 500.
Unbelievable.
And like this plays out around the world. You can look up the SPIVA scorecard, but they track the US, Canada, Mexico, Brazil, Chile, Europe, the Middle East and North Africa, South Africa, Japan, and Australia. And let me tell you, the consistent thing is the index is pretty good.
Yes. So that's just another feather in the cap for the index. To close out, obviously the simplicity of index funds is hard to beat. You can set and forget. They're bottom drawer, they're low cost, they're well diversified. You don't need to check them, you don't need to touch them. The mechanics of it means that it's all done for you. And because of that, they are a great investment option for dollar cost averaging into.
Yeah. Now, there are some things that index funds don't offer, so you just need to be aware. One, you're not going to go to the moon on an index fund. You might go on a very slow ride to the moon and you try and get rich slow because you just might do it, but there's no going to be like 10x wins. It's not the exciting investment option.
Not overnight.
And it is still subject to the market up and down. So just because over the long term it consistently grinds upwards doesn't mean there aren't periods where it falls 30% or 50%. Low risk doesn't mean no risk. And so it's important that you're only investing money that you're not going to need to draw on in the short term.
Yeah.
You're not going to need to pull it out to cover your bills, or you don't to go on a holiday or for a house deposit or whatever it is, because the stock market is volatile.
Yeah. So that brings us to the here and now, which is how we invest in index funds, and it is all done through exchange traded funds.
Yeah. So I think just to the history of it, in the 1970s, John Bogle, he created the index fund, but to invest in an index fund, you had to fill out paper-based forms, you had to mail it off with a check. It was pretty clunky. Then in the 1990s, the next innovation, starting in Canada but spreading across the world, was the invention of the ETF, which allowed you to buy an index fund in one simple transaction, simply like online shopping through a broker. And so that's the powerful combination, index ETFs.
Some examples of Australian-based index ETFs. There's the all-in-one options. You've got the BetaShares Diversified High Growth ETF, Vanguard, same thing. They have a high growth VDHG, and then they have an all growth as well, VDAL. I would suggest searching best ETFs for quitting your job. It's a podcast that we did that goes through all of these ETFs. But Australian index ETFs, if you want access to the ASX 200, you've got A200, IOZ, and VAS. And then if you want access to the US, the S&P 500, very popular, IVV. And then the tech-heavy NASDAQ is NDQ.
This is probably a good point to just touch on the last part of Emily's question, which was, would she have been better off putting all of her money into a single all-world index fund rather than splitting it across 4 index funds which track different regions? There's no right or wrong answer to that. Like index funds are all great in all shapes and sizes, I would say. You want to be globally diversified, and either option that Emily's suggesting would have given her global diversification. I actually think the answer to Emily's question isn't in the choice of product, but more the broker she uses. So she's investing $25 a week. If she's investing that across 4 ETFs, then she's paying brokerage on 4 ETFs weekly. So in that instance, small amount of money, I would say you want to do one ETF to minimize your brokerage. She said in her question she was with Sharesies.
Yeah.
My answer would be different if you were with a broker that didn't charge brokerage. So a platform like BetaShares Direct would allow you to invest in 4 ETFs with no brokerage.
Yeah.
So Emily, I think there's no bad option in terms of the index funds that you're thinking about there. The real answer to your question comes in minimizing your costs as much as possible, because the worst situation is you're investing small amounts and all of a sudden 10% of the amount you're investing is eaten up in brokerage costs. You're just putting yourself behind the 8 ball.
Yeah. Well, we said we'd come back to Warren Buffett to close out. And if you're still not convinced, then let's double down on what he said. So despite making his fortune, hundreds of billions of dollars by actively picking stocks, Warren is very famous for his shareholder letters. And in 2013, he wrote to his shareholders suggesting that he would be leaving very different advice to his family when it came to his will. He said, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers."
But he didn't just say it. He put his money where his mouth was. In 2008, Buffett made a famous bet with a hedge fund manager, Ted Seides. Buffett said he didn't believe there was a professional investor who could beat America's index fund over the next 10 years.
Yeah.
Buffett's an index boy.
Yeah, big time.
Us and Buffett. So the two, Ted and Warren, each put up 500 grand. So there was $1 million pot, and the winner would choose which charity that money went to.
Yeah.
Unsurprisingly, given we're closing this episode with it, Buffett smoked his competitor.
Yeah.
By 2016, when Seides conceded he lost the bet, 2 years before the bet was over, he conceded, I've lost this.
Yeah.
The index fund had returned 85%, and Seides was able to choose 5 professional managers to go up against the index. The average of those 5 professional managers, 22%.
Well, there you go. I think that illustrates why we love the index fund. It's very hard to beat. The returns are awesome. It's low cost. It's diversified. And the best investor in the world is willing to put the fortune that he's built over 60 years into these products for the next 60. So anyway, that brings us to the end of today's episode. Thank you, Emily, for the question. A great one there. If you would like to ask a question just like Emily did, head to equitymates.com/contact and leave us a voice message. If you've taken a lot out of today's episode or you find value from all of the content that we create, we would really appreciate it if you could share this episode with a friend or a family member who is looking to start investing in index funds. Like the video, leave us a comment. We love hearing from you. But Ren, that's it for now. We'll pick it up next week.
Sounds good.